Here's where I get to the art market, though. Think about any well-known artist that you might be familiar with. I'll pick Picasso because that's usually a name that everyone's aware of. I can guarantee you that no matter how high the price of Picasso's paintings go, Picasso's not painting any more paintings.
Yeah.
So the supply story in the art market is actually significantly more attractive, I think, than other real assets.
Hello, I'm Addison Wiggin. This is the Wiggin Sessions. Today I have with me Alan Sukholitsky, who is the Chief Investment Officer at Masterworks. Masterworks is the leading art trading platform for the self-directed investor. Formerly, Mr. Sukholitsky was the Senior Trading Strategist for Goldman Sachs and has been working in global markets for over 2 decades. Welcome, Alan.
Thank you. Great to be here.
Thank you for joining the Wiggin Sessions. Before we get started with Masterworks, you've been working in global markets for a couple decades. We haven't seen a market like this in a couple decades. Could you start just by giving me your overview of what's happening with inflation? The day that we're talking right now, the Fed is meeting again. We're awaiting the next news on the rate hikes. What's your view of what's going on?
Yeah, I mean, you know, there are a whole bunch of factors that probably brought us to where we are today. You know, just a couple of years ago, in the midst of the start of COVID, you had equity markets enter probably the most short-lived bear market in history, if not, you know, many decades at that point. Lasted about 2 months, then equities took off, and sort of concurrently, you had some of the most expansionary monetary policy that, frankly, any central bank has ever engaged in. So despite all of that, you know, for a period of time, it looked like inflation was maybe creeping higher slowly, but not to the levels it's at today. And you had a lot of central bank officials kind of making statements along the lines of, well, you know, some of these increases, they're going to be transitory. It's not really anything worth worrying about. Then it gets to the point where you make those same claims for so long while inflation continues to move higher.
Yeah.
And the market starts to realize, well, maybe it's not so transitory. Now, you know, the interesting thing is, just as much as they might have been behind the curve and not realizing that inflation was going to spike to the levels it's at today, I would not necessarily be surprised if inflation actually starts creeping lower over time, right at the point when the Fed actually started to finally address the issue, right? I mean, it's almost like, you know, you're late to the party and then you stay longer than everyone else kind of thing. So where we are today, I mean, you know, I'm not in a position, at least anymore in my career, to make calls on what the inflation environment is going to look like a year from now. But I do think that there's the potential for some irony in the fact that the Fed took so long to recognize the issue. And now once they've started addressing it, it might end up actually resolving itself sooner than expected.
So what happens if they continue to address it, even if the market is taking care of the situation?
Yeah, well, I mean, if they continue to address it, I mean, what that effectively would mean is they continue hiking rates into an environment when inflation starts to come down on its own, right? And that, for a global economy that's as indebted as ours is today, at least relative to where it was several decades ago, I mean, that's, you know, not necessarily the most rosy scenario to find ourselves in. I mean, realistically, what would probably happen, and the Fed has demonstrated this in the past, is that they are more than willing to turn around and do the exact opposite of what they've been doing up until now in order to address a bigger problem. And I think the bigger problem for them would be, if inflation starts to come down, markets continue to weaken, growth continues to slow, and then they're kind of faced with this situation where it's like, well, we gave the rate hikes, the only reason for that being elevated inflation, but if we don't even have that anymore, now it's going to be a hiking environment in the midst of falling inflation, weakening growth, weaker equity markets. And I think in that type of situation, they would have to turn around very quickly and they would probably start cutting rates, which, as we know, They usually prefer to do more than anything else anyway.
Yeah, the so-called Fed pivot, right?
Yep, that's the idea.
On the inflation side, a lot of it is caused by supply chains that were disrupted and continue to be disrupted during the pandemic, and as we're coming out of it. And also, of course, we have the war in Ukraine, so you have like grain shortages and disruptions in the fuel markets. A lot of those are things the Fed can't do anything about. They're trying to draw down demand to meet the supply, but they don't have a lot of control over supply side inflation, right? So when you're saying that it's going to take care of itself, are you saying that the supply chains will open up slowly and then there'll be supply enough for prices to start coming down?
So that's one element. The other element, and the part that they can control, is ultimately what they are or are not doing with the supply of money. And one of the reasons why I think we ended up with so much inflation as we did was not only because of supply chain dynamics, which undoubtedly were at play. I mean, those are the types of things that it's almost impossible to ignore or pretend that they didn't happen. Everybody knew that they happened. In the midst of a global pandemic, when people aren't able to go to work and do all the things that they normally do, obviously there are going to be supply chain issues. But the other element was how significantly they increased their balance sheets. That often gets focused on less because I think the sort of monetary side of what central banks do has generally just been mostly ignored for the last few decades. But if you actually take a look at it, what's happened in very recent history is the increases in the money supply have actually slowly started to slow down. And so what I'm referring to when I'm saying that inflation could slowly rectify itself, yes, one part of it will be that supply chains will, over time, little by little, open up again, since the world is not as locked down today as it was before. But the other element is that all of that expansionary monetary policy is also starting to go away. So between those two sides, it is actually possible that right as the Fed is beginning to get really serious about fighting inflation, you could start to enter a period of time where inflation might actually slowly start to taper down.
One of the reasons we don't talk about monetary policy that much is a lot of people, it just confuses people. So if you're trying to manage your own money, you're not involved in the discussion about expanding on the monetary base or any of those things. A lot of it's difficult for individual investors to dig into that.
Yep.
So we primarily talk to individual investors. Can you just explain really quickly, like quantitative easing and how they actually get money into this system?
Yeah, I mean, the way that the expansion of the money supply process works, especially nowadays, is it's mostly done digitally, frankly. So you sort of create these, additional dollar figures that eventually enter into the financial system. The banks usually get that first, and then it slowly trickles in through the rest of the economy. And that's often why you don't see prices increase in every segment of the economy at the same time. It's because money doesn't actually enter into the economy everywhere at the same time. It sort of enters through the financial system, through the banks, and then ultimately trickles throughout the economy. So I mean, the way it works now is far more digitally oriented than it used to be. I mean, in the past, it was a somewhat more complicated process, in the sense that you literally were printing money. I mean, that's where the whole concept of, helicopter money came from. But nowadays, there's not really a need so much to print money because, frankly, there aren't that many people that use money, cold cash today, as at least they did decades ago. So now it happens just more in a digital format. The central bank literally will create, digital dollars in a sense, and it slowly trickles through the system, starting with the banks.
You said earlier that a lot of people just don't even pay attention. A lot of even economists don't pay attention to the monetary base anymore. And you said over the past couple of decades, is that because of like the Greenspan, Bernanke, Yellen era?
It's hard to pinpoint exactly what the reason would be why they don't pay as much attention to it. I mean, one of the reasons could be simply that decades ago, the Fed actually was far more focused on using expansions and contractions in its balance sheet as a way to drive monetary policy. Nowadays, they focus much more on the interest rate itself, in the sense that they target interest rates now, whereas a long time ago, they actually targeted levels of monetary supply expansion or contraction, but mostly expansion, obviously, but nevertheless, they were targeting money supply. Now they target interest rates. So it's in a sense, I guess it's somewhat opposite ends of opposite sides of the same coin, where, you know, you can target the money supply and you let interest rates react accordingly, or you can target interest rates and let money supply react accordingly. Effectively, it's kind of the same approach, but coming at it from a different angle. So some of the reason, or the best guess I can come up with as to why, you know, a lot of economists maybe don't focus so much on money supply anymore, is because it's not really explicitly targeted by central banks anymore. I mean, that's kind of the best explanation I can come up with. But I do ultimately think there is something. You know, I'm not going to say that you're missing the absolute most critical element of any economic conversation by leaving the money supply out. But I would say that for something seemingly, you know, conceptually as important as the size of the Fed's balance sheet and how much money is or is not entering the economy, it does seem a little bit curious, I guess, at the very least, that something like that would generally not have a lot of attention paid to it in recent times.
When the money leaves the banks and goes into the economy, certain asset classes do better than others. Typically, gold goes up, but they seem to be having the precious metals seem to be having a battle with crypto.
Yeah,
who is going to be that flight to safety trade. What asset classes you see doing best, like say over the next 6 months?
Yeah, I mean, you know, I'm biased obviously, because ultimately I'm working at a company that's making art investable. Frankly, the first company ever to make multi-million-dollar works of art investable. But it's interesting that you bring up precious metals, commodities in general, because, you know, it's one of those things where, and I'll just say it as a side note, I'm not sure how many of your listeners are, you know, let's say as familiar with commodity markets, gold, oil, so on and so forth. Some investors are more familiar, some are less familiar. But the interesting thing is there are some elements that commodities actually share with the art market, but there are also some ways in which, frankly, I think the art market is even more attractive. And I'll explain what I mean here. So with gold and oil, these are, at the end of the day, real assets. So when you're experiencing an inflationary environment like the one we're in today, the one we had during the 70s, typically real assets do better because, you know, to put it bluntly, you can't just print more of them, right? So if inflation is rising and you have a real tangible hard asset like gold or oil, whatever the case may be, ultimately the value of those should hypothetically go up, precisely because there are more dollars in circulation chasing those real assets. Okay, so in a sense, art is also a real asset, right? It's tangible. You are talking about multi-million-dollar paintings. But the reason why I say that art, interestingly, might even be more attractive as a real asset than even things like, let's say, gold and oil, is precisely because of the supply element when it comes to the art market. So here's what I mean. With oil and gold, if you want to increase the production of either one of those, the only thing that really needs to happen is the price of either one of them needs to go up considerably. If you're a person or a company that's drilling for oil and all of a sudden you see oil prices go up sky high, you are pretty incentivized to drill for more oil. If you are a gold mining company and gold prices go through the roof, you are probably quite incentivized to mine for more gold. Here's where I get to the art market, though. Think about any well-known artist that you might be familiar with. I'll pick Picasso because that's usually a name that everyone's aware of. I can guarantee you that no matter how high the price of Picasso's paintings go, Picasso's not painting any more paintings.
Yeah.
So the supply story in the art market is actually significantly more attractive, I think, than other real assets.
Is that why you left Goldman Sachs? I'm just curious how you made that transition. I know that Masterworks hasn't been around too long.
The reason I came to Masterworks was because I saw an opportunity that, frankly, I never expected to see in my career. And here is how I'll tell you about my thought process. So while I was at Goldman, I was basically in a macroeconomic research and asset allocation capacity. So I would research all the major asset classes. I would give views on what I thought was a more attractive or less attractive investment opportunity, how to think about them in terms of a portfolio, so on and so forth. That's what I did. Now, what I didn't know in all the years that I was doing that was that all around me, all around the world, there was a nearly $2 trillion asset class that all of us are familiar with in some way. Sometimes we see it in our house. Sometimes we see it in a company that we might visit in their office. Sometimes we see it in museums that we go to. This asset class is literally all around us. It has existed for centuries, long before companies were going public, long before companies were issuing debt. This asset class has existed forever. So it's got all of those. And here's the kicker that really sold me. The kicker was, despite everything I just said, almost no investor has ever thought about investing in it the way that they think about investing in their stocks and their bonds or their gold or oil or whatever else that they might invest in. And that to me spelled enormous opportunity, because what I could eventually become part of was not a company that was creating something literally brand new along the lines of, let's say, cryptocurrencies, which actually didn't even exist before, whatever, 10, 11, 12 years ago. We're not bringing anything new to the market. We're actually coming to investors and saying, we want you to consider an asset class that for one reason or another, the entire investment industry just completely forgot about long ago. And despite the fact that that asset class has existed for so long. So what we are doing is making that asset class investable, accessible. And what sold me on the idea was to be part of the company that is making an asset class available that, as I always say, should have been invested in a long time ago. It's just that nobody figured out how to make it accessible until Masterworks came about.
Yeah, because I think when most people think about investing in art, it's almost akin to taking delivery of your gold. You have to kind of like figure out how to do it. And then with art, you got to pick a piece and generally buy the whole thing. But with Masterworks, you can buy parts of it.
Yep, we fractionalize it. That's right.
Can you explain how that process works a little bit? Because I think that I'm going along with your accessibility idea. Most people don't think it's only something that rich people do. But what is rich, and how much do you need to buy a Picasso? Or would you buy a Picasso if you had enough money to win it at auction or something? So explain how Masterworks works, because you can be interested in a piece of art and then own a share in it.
Yep. So the way the process works, I mean, it's funny. It always kind of I always find it somewhat funny when I talk through the process, because the truth is, the way that I'll explain it, it's actually so incredibly easy, straightforward. But the thing is, at the time when we started doing it several years ago, it was quite revolutionary because nobody had done it before. But it is very straightforward. So the way that it works is we buy a painting, a multi-million-dollar work of art, and in a few minutes or whatever, we can get into what our criteria is for making the investments that we make, but let's put that aside for a moment. So we buy a multi-million-dollar work of art. We create an LLC. In other words, we form a company. We put that painting into that company. So that company owns one asset, which is that painting. We file that company with the SEC, and we take that company public. So when investors are buying shares in that company, remember that company only owns one thing, which is the painting that we just bought. So when investors buy shares in that company, they are effectively buying shares in a painting. So the idea of putting an asset into a company, taking the company public, and letting investors buy shares in it, it's pretty straightforward and easy to talk about now, but you can imagine that at the time, before anybody had ever done this before, I mean, that was truly revolutionary. But at this point, we basically securitized, I think, if I'm not mistaken, we're coming up on about 150 paintings worth probably north of $600 million. So we've been doing this now for several years, to say the least. And, it seems like investors are quite interested. We now have well over 500,000, in fact, that are signed up on our website who are sort of waiting to learn more about art investing.
So when you buy a share in a company that owns painting, let's use Picasso again, those shares are tradable like any other share, right?
So you can, well, so on the Masterworks website, we actually do offer a secondary market. And, you know, I need to give kudos to the Masterworks team for thinking through this when the company was initially founded, because to have enough foresight to launch a secondary market for the assets that you're offering investors to invest in, to think about doing that at the same time that you're even making those assets available as an investment in the first place, I personally think that that took a whole lot of foresight. But the benefit is, now that that secondary market has been operating for several years, we do use it as a way to tell our investors, you know, when you invest in art, you should expect the holding period for any painting you invest in to be, let's call it 3 to 7 years, or on average 4 to 5. Now, there are times when it can be considerably shorter than that, but I'll put those aside for a moment. The point is, you should expect 3 to 7 years. But because we have the secondary market, if you do want to sell your shares before we ultimately sell the painting, you do have the ability to do that on the secondary market. It's been functional for several years now, and quite honestly, in the coming, well, I was going to say weeks, let's just call it months, just to be careful. I think, are going to have some pretty new functionality on that secondary market, which should probably make it work even more successfully than it has so far.
So to your first example, though, if you wait 7 years, you hold on to the share for 7 years, and then the effective IPO is to sell the painting, or the returns to the company.
Yep. So we will
sell the painting.
Yep, we'll sell the painting to any one of the, let's call it, hundreds of intermediaries, collectors, and sort of generally art-oriented individuals around the world. We'll sell a painting presumably to one of them. We might do it at auction too, but that's not sort of our first route in terms of selling the paintings. So we'll sell it to whoever we sell it to several years after, and ultimately we return the proceeds and profits back to investors. We've done that now several times. I think we've sold about 7 or 8 paintings. The performance, frankly, for all of our sold paintings has been quite stellar. The average was a net, meaning after fees, return of almost 30%. That's the average across all the paintings we've sold so far. And ultimately, you know, we're operating in a market that has been uncorrelated to any other asset class for centuries. And it makes sense because, you know, the way that, you know, you ask almost anyone that you might talk to, do you think about art the same way that you think about stocks and bonds, commodities, or anything else? And they'll probably look at you like you have several heads, because, you know, nobody thinks about art that way. And so by definition, the art market has not been behaving like any other financial instruments. And for us to be the only institution operating purely from an investment perspective in a $2 trillion asset class that almost nobody else in that market operates in with a purely investment perspective, we think that gives us quite a bit of an ability to generate alpha for our investors.
Do you have an opinion on NFTs?
Somewhat of an opinion, I guess. You know, we were on record over the last few years expressing skepticism about NFTs. We were asked the question, honestly, quite a lot, mostly because since we are pretty much the only firm that's involved in the art market, I guess to a lot of people, it seemed sort of a natural fit to ask us about NFTs, at least to the extent that you can consider NFTs to be art. We were skeptical about them over the last several years, and I think in the midst of crypto doing well, and frankly NFTs, at least for a period of time, doing well, you know, whatever things we would say would fall on deaf ears in a lot of ways. But given what's taken place with crypto this year, and also NFTs for that matter, I think all of a sudden, you know, we're being reevaluated in terms of everything that we were saying before about making the case for, you know, the ability for art to sustain its value. That really only works for the most part if the art that you're talking about is actually real and tangible and limited in supply. That's a very different story in the NFT market. And so, you know, I have to be honest and tell you that even this year, we've had crypto and NFT investors who have actually come to our platform somewhat out of disappointment for the asset classes that they were invested in previously. I mean, they like sort of the new interesting nature of what we're doing because nobody else has really ever made art investable before. So I think that novel element is interesting to crypto and NFT investors. It's just one of those things where, you know, I would have preferred if the performance of NFTs and crypto was not necessarily the reason that they came to us to express interest in art investing. But, you know, sometimes there's only so much you can control ultimately.
Yeah, it seems like a lot. I mean, that's where crypto and NFT money was going. It was going into stocks. It was going into other asset classes. It was going into real estate. Somebody offered me Bitcoin for a property that I have done in Nicaragua.
Yep.
And I was like, that's not a good trade.
Yeah.
I'd rather have the land.
Yeah. Yep.
How you were going to tell me how you source the paintings, like the criteria that you have.
Oh, right. So this is truly about as unique as it gets as far as investments go. And I can say that because I spent my entire career working in, you know, the traditional investment management world. Here's what I mean. So most individuals who are investment professionals working in financial institutions, whenever they need data for any sort of financially oriented instrument, any kind of financial data, they typically go to one of their data providers. For most investment professionals, that's a Bloomberg terminal, but there are other data providers out there. The point is, if you need financial oriented data, there are a whole bunch of data providers that you can go to and you can access that data. So everyone around the world who's an investment professional has access to all of that same data. Everyone's using the same data. It's just investment professionals obviously try to analyze it better than the next guy to hopefully make better decisions, but they're all using the same data. Now, in the art market, there's no such thing as an equivalent of, let's say, a Bloomberg terminal for the art market. It doesn't exist. And if you're wondering why doesn't it really exist, the answer is sort of obvious. Well, I mean, how many institutions or people can you think of that have been investing in the art market for decades, the same way that they've been investing in stocks and bonds and everything else? There probably aren't many you can think of. So why would anybody actually create something like a Bloomberg terminal for the art market? So as a result of that, the first project that we engaged in at Masterworks was we bought up every catalog known in existence from all over the world. There were thousands of them. And we gave more than 30 analysts one job for approximately 2 years. And that job was to take every single transaction that has taken place in every page of all of those catalogs and to put all of that data into a computer. So we have since built what I describe as the most comprehensive source of transaction data in the art market going back roughly 70 years. So when we're analyzing what areas of the art market to invest in or not to invest in, what areas seem to appreciate more attractively than other areas, are some more volatile than others, all of these questions that investment professionals typically answer for whatever asset class they cover, we are doing it for the asset class we cover, except the huge difference is nobody else has access to our data, whereas everybody's got access to all of the other asset classes' data. So that's how we analyze the market to decide where to invest.
What kind of pieces, or what are your favorite pieces?
Yeah, so
that you have?
Here's what I'll say. So the segment that we focus on within the broader art market, it's post-war and contemporary art. You can think of that as generally anything that's been produced after 1945. There are, if I had to kind of describe the different segments of the art market, I would put them into three very large buckets. Bucket one would be old masters paintings. So old masters along the lines of Rembrandt, Da Vinci, literally artists who were painting hundreds of years ago. The second category would be impressionist and modern art. And then the third and final category would be post-war and contemporary. Now, old masters paintings, the ones that were painted hundreds of years ago, the appreciation rate for those over time is about 2 to 3% annualized. So honestly, not exactly that interesting from an investment perspective. Impressionist and modern art appreciates at, let's call it 7 to 8% annualized, which is more interesting undoubtedly. But post-war and contemporary art, that's been appreciating the last few decades for about 14% annualized. And if you're wondering what is it that drives these different segments of the art market to appreciate at different rates, the answer that our founder actually always gives, and I think it's probably the most accurate answer, it's also, I love the description itself, which is the art that you might be interested in buying for your home is not the same art that your grandparents were interested in buying for their home, and that's probably not the same art that their grandparents were interested in buying for their home. So there's almost this cascading or sort of recency-oriented effect where the art that was produced hundreds of years ago, it's not going to be appreciating nearly as fast as the art that was produced in more recent history. So we focus on post-war and contemporary, and then within that segment, we focus on art that is generally north of $500,000, that's really sort of at the very minimum, up to roughly $30 million. And there's a good reason for that too. When we were analyzing that treasure trove worth of data that I described before that we aggregated, we analyzed it, as you might imagine, anybody with a source of data like that, you would analyze it every which way imaginable to figure out, where to invest, where not to invest. What we learned is that for art that sells for under $500,000, that segment of the art market is extraordinarily volatile. So the way I would describe it is as follows. You buy 10 paintings, one of them might be worth an extraordinary amount. 9 of them might be worth very little. And we don't really want to be active in that segment of the market because there is so much volatility and uncertainty. We don't really think it's a good idea for us to offer those as investment opportunities to our investors. But this segment over $30 million is also actually a segment that we don't want to focus on. And the reason why is because once paintings go over $30 million, their returns actually fall off a cliff. Not that they go negative, I just want to be clear. It's not that they go negative, it's just that they're kind of low to mid single digits, which we don't necessarily think is that attractive for investors. So our sweet spot is, let's call it roughly 500,000 up to $30 million within post-war and contemporary. That's really our where we focus our efforts.
For some reason my screen is frozen here. Is it frozen for you too?
You've actually, you have been frozen for a while, but I could hear your audio, so I just kept going.
That's kind of weird.
Yeah, like you've been this way frozen for me since probably a minute or two into the conversation.
Oh, really?
I just didn't say anything because I could still hear you, so it's fine.
Yeah, that's fine. I'm just going to pause the recording real quick. And
sure.
It's weird. I don't know what it's doing. Well, we'll have to do some video editing. All right. What was I? Oh, I was going to ask you, do you have a recommendation on what percentage of one's portfolio should be in art?
Yeah. So my favorite way to answer this question is actually not to refer to our own research, mostly because you can imagine that if we're a company that's making art investable, we would presumably be incentivized to suggest that investors allocate oversized positions to art. So I would much prefer to cite third-party external research to answer this question. Citi Private Bank is an institution that honestly I think has been quite forward-thinking in their asset allocation work that they do. They actually several years ago began to incorporate art into their asset allocation models. I think the impetus for that was probably that a lot of Citi Private Bank's clients are ultra high net worth individuals who probably own art collections themselves. So it's a way to sort of incorporate these assets that their clients own. But nevertheless, the approach that Citi took was to say that if you are an average risk tolerance investor, so I'll describe it roughly as, it's not that you have all of your portfolio in stocks, it's not that you have all of your portfolio in bonds, you're sort of somewhere in the middle, right? So you're an average risk tolerance investor, and you have the ability to have 15% of your portfolio in illiquid asset classes. Those would be things like private equity, real estate, infrastructure, art. So 15% of it can be in illiquid. If you are one of those people, they would recommend an allocation of 4% into art. So the general guidance that I give is to think of the art allocation as, let's call it mid-single digits for an average risk tolerance investor.
And how do they go about? They go to your website to look at what the offerings are?
Yeah, so we make the process extraordinarily easy. If you go to our website, which is masterworks.com, you can ultimately learn about what Masterworks does, how it does it. You can sign up for a free account, totally free. It's very easy. Once you sign up for a free account, you can see all of the different offerings that we have available at any point in time. And ultimately, if at some point you're interested, maybe in learning more about actually investing, you can schedule a call with a member of our membership sales team, and they will talk you through the investment process. They'll talk you through the different opportunities that are available at any point in time. And, honestly, I would describe those conversations very similarly. If any of your listeners have their own financial advisors, let's say, that they work with, the same way that a financial advisor will sort of work with you to understand what's your risk tolerance, your investment time horizon, all of those things that you would want someone to know when giving you guidance on making investments. Those are the exact same conversations that our membership team has with investors who sign up on our website. So again, easiest way to do it, you go to masterworks.com, sign up for a free account. You can look at all of the different offerings we have. And on top of that, actually, we even have a price database that we offer to people who sign up for those free accounts. What you can do is you can actually go into the price database. You can type in, your favorite artist, and you can get a whole bunch of the different artworks that artist produced. You'll have an understanding of what types of returns those particular works of art have generated. So think of that almost as the surface level data that was part of that enormous data-oriented exercise that I described before. Obviously, for proprietary reasons, we can't release all of our data, but we do offer that price database on our website, totally free of charge, as something that might help investors get a little bit more informed about the art market. How much do certain paintings sell for? What do the returns look like? All of that information we like to provide to investors.
It sounds great. I had spoken to Scott. He's the founder, right?
Yep.
I spoke to him on the Wiggin sessions like maybe 6 months ago, and I poked around on the site, and it was really easy to use. Have you made any improvements in the last 6 months?
I would say that we're making improvements all the time. The most obvious one that I can think of, actually, mostly because it involved me specifically, was that we began to include Sharpe ratios or risk-adjusted return calculations for the different artists that we have available for investment purposes. So if you look at any of the offerings that we have, you will see a Sharpe ratio or a risk-adjusted return calculation there that gives you a sense of what has been the historical risk-adjusted performance of this particular artist that you might be thinking about investing in. And the reason why I remember that change so clearly is because I think, if I'm not mistaken, next to that Sharpe ratio number, I think there's maybe like a question mark, or there's a way to sort of click to learn more about what is a Sharpe ratio. And I believe that opens up a video that I recorded describing what is a Sharpe ratio, how to think about a Sharpe ratio, things along those lines. So that's one change that we've made. I mean, the truth is we're always trying to increase the level of education that investors have on the art market. It's one of those things where we know full well that even though most people are familiar with art, at least in some way they're familiar with it, even if that just means they look at it occasionally in a museum, like they know what it is. The thing is, beyond that sort of baseline familiarity, we know that there's quite a bit of an educational component that we need to offer to the investor community in order to make them comfortable to invest in art. And so we're always doing that to the extent that we can.
Has the portfolio of works increased?
So the portfolio has done quite well. I mean, at this point, I think we've.
Oh, no, I mean the number of options.
Oh,
number of pieces.
Yeah, so we are bringing to market roughly 1 to 2 new paintings a week, which gives you an idea about how extraordinarily active our pipeline is. So we've got about 1 to 2 new paintings a week. Anytime you go to the website, you will see I mean, I'll give a broad range here, but let's call it on the low side, you should see at least 3 paintings available to invest in, but you could see as much as 10, 12, whatever the case may be at any point in time. So you will have lots of options. You can choose to invest a number of different paintings to sort of create some level of diversification in your portfolio. But we are ultimately very actively buying in the market. You know, it's one of those things where if you're buying 1 to 2 multi-million-dollar paintings a week, you probably are a pretty active buyer in the art market.
Yeah. Well, now you can answer the question you thought I asked. How's the portfolio?
Right. So the portfolio's done quite well. I will, you know, we're literally finalizing the numbers, but what I will say is we've hit our 3-year track record, which is actually quite a bit of a milestone. In the investment community, you know, there's a lot of emphasis that gets put on any investment manager's first 3-year track record. And what I will say is at the moment, it looks like we have outperformed 15 major asset classes, all of the ones that you would probably think of, stocks, bonds here in the U.S., internationally, hedge funds, private equity, real estate. I'm kind of doing this all from memory. Point is, we outperformed about 15 major asset classes, but I don't want to actually spell out any exact figures yet until those numbers are officially official. But it is looking like through this September, our 3-year milestone has been quite a bit of an accomplishment, especially relative to everything that's been going on in markets this year.
Yeah. Will you be publishing that data on the website when?
Oh, for sure. For sure. I mean, one thing you can already see when you go to the site, you can see all of our previous sales, meaning paintings we've already actually sold and returned profits to investors. You can see all of those paintings on our website too. That was the figure that I think I referenced at the beginning of our conversation when I said, you know, if you actually look at the performance of all the paintings we've sold, that's almost 30% on an after fees basis on average, which is, I think, pretty incredible. But you can see the details on our website.
All right. Well, I am going to encourage readers and viewers to go ahead and check out your website and learn a little bit more about investing in the art market. It's like you said, it's kind of perceived to be inaccessible, but Masterworks has innovated their way into that space, which is pretty interesting.
Yep. Thank you.
All right, Alan, it's nice to meet you. Thank you for joining me, and I will be in touch.
Thank you, Addison.